We've seen pressure on oil today, although it is off the lows of the session. Generally, investors are pulling back from risk, partly because central bankers just keeping spoil sports, warning that interest rate cuts are not coming soon. But you might argue that oil should be a lot higher given these disruptions to shipping in the Middle East. Let's get insight now from Bob Yawger, energy futures strategist at Mizuho Americas. Bob, it's always great to talk to you. I mean, is it mystifying that oil is so low given the attacks on ships?
Well, the geopolitics, historically speaking, Andrew, you definitely have a point. It's one of the most skittish commodities in the universe is the energy sector. And whenever you get some kind of geopolitical hiccup, you tend to rally rather strongly. However, we have two opposing forces working here that are keeping that from happening. First of all, you have a lot of crude oil in the world, Andrew. United States, we were at the all-time record a couple weeks ago. We've looped 100,000 barrels off of our all-time record of 13.3 million. That's a lot of crude oil coming from the United States. We also have a lot of oil coming from Brazil and the new kid around on the block, Guyana. So the OPEC has cut a significant amount of their production this year, theoretically as many as 6 million barrels. But the United States and especially Guyana and Brazil have filled that void. So there's plenty of supply. But the other thing, and which just really came home today, was Chinese demand. There's a lot of worry around Chinese demand, Andrew. Their GDP number did not really perform as well as expected today. Came in a couple ticks lower than expectations. And the Chinese stock market, in both China mainland and Hong Kong, took a beating today. So the mainland's index is trading close to a 5-year low, and Hong Kong is trading at a 3-year low. That's not the kind of situation that generally exists in an economy that's rip-roaring that would generate a gigantic crude oil demand number. It's the opposite, and it's souring perceptions around the energy market.
OPEC, though, says, well, I guess they would, that global oil demand is strong. I mean, has there really been a sign of a drop in demand, Bob?
No, we're chopping around a little bit north of 100 million barrels a day. It's a strong number. But, as far as the OPEC folks are concerned, they actually talked the market lower today, though. Their monthly report came out. They kept their 2024 demand growth number unchanged at, 2.25 million barrels. They gave their first inkling of what they're expecting in 2025, and that was only at 1.8 million barrels. So right there, they're admitting to a certain degree of demand slowdown, demand growth slowing. But then the OPEC Secretary General, he came out and he talked down the concept of peak demand, which there are some analysts throwing that concept around out there. He said that is historically wrong and logically wrong. So he has brought up the case that people have speculated on this issue before, and it never pans out. So on the other hand, him kind of driving home the point made it look as if he was a little excessively worried about it also.
Yeah, just to remind us of those numbers, OPEC, excuse me, sees global oil demand up just over 2 million barrels a day this year to a record of just over 104 million. And then next year, the growth forecast, only 1.8 million. Are there any regional differences emerging in terms of tightness of supply? I mean, America has so much oil now, as you note, record levels of production or near record levels. Is there trouble exporting all that oil? Is there demand out there for it?
Well, I was on 2 weeks ago and I was talking up the U.S. barrel, how attractive it is because of two issues. First of all, you can sail a vessel to the Gulf Coast and back to your refinery in, let's call it Rotterdam, and not have to worry about it taking a missile in the side. Also, as of today, it's about $5.90 cheaper at one point today. That's a multi-month record low. And so it's cheap. And cost of carry is usually about $4. So for a Rotterdam refiner to sail a boat over to the Gulf Coast, sail back, with a full load of crude oil, that usually takes about $4 a barrel. However, the differential between the U.S. barrel and let's call it the North Sea barrel, the U.S. barrel is almost $6 cheaper. So you make $2 off of what you're usually doing. And the U.S. barrel is higher quality, too. It makes a lot of gasoline, as opposed to the North Sea barrel generally makes a lot of distillate. So you want the gasoline grade more often than not. It's in wintertime, it does spike towards heating oil a little bit, but still, day in, day out, gasoline, you want gasoline all the time.
How about heating oil in the U.S., Bob? That kind of reminds me, you've had some bitter temperatures there. Have any shortages developed in the Northeast?
No, we have not, because in the last two EIA storage reports, we posted up a number above 10 million barrels 2 weeks ago, and we posted up another whopper last week. And so storage, the refineries is running really hot, or has been running hot for the last couple of weeks. Now, last week in the EIA storage report, they actually cut the refinery run rate because it's making too much heating oil. It's making too much gasoline. Product was piling up in storage and putting pressure on the products. If the refiner doesn't make a lot of money off those products, or if he doesn't make at least a pretty penny, he's going to cut back on the refinery utilization rate. And that's what we're seeing here. The relative price of gasoline and heating oil, and diesel for that matter, relative to crude oil, has it's at an all right level, but it's definitely not printing money. So the refiner, what they do then, they cut back the amount of crude oil that goes through the refinery, and that raises the price because it creates less product. The problem with that scenario is, Andrew, that when you run less crude oil through the refinery to make less product, those barrels of crude oil you don't use, they get sent to storage. And that ultimately puts pressure on price.
Leave us with a final thought, Bob. Does oil have any prospect in the next couple of months of making it back towards $80 US, say?
It's crude oil. It always has a chance. Matter of fact, the options tell you probably volatility is all right, so it's saying there is a chance. Hasn't been there in a while, though. Hasn't been there since the last OPEC meeting, when which blew up in OPEC's face and put pressure on prices. I would say, to give you a percentage chance, I would say that's about a 20% chance that we get to $80. The downside below of 70, the likelihood of us popping below there is relatively a lot higher than 20%.